A very good afternoon, everyone. Welcome to the 1st of September weekly market review. We have ended the month of August on a positive note, I guess. But before we dive into the details, let me welcome Gerald. How are you, Gerald?
Hi, Sunny. Hi, everyone who has joined us today. Very well. So we have ended the month of August with the markets actually being close to record highs. I think for September, many investors are looking out for the potential interest rate cut. So that's something that I will share more about today.
Yes, indeed. Market is looking very promising going towards the end of the year. We traditionally August used to be a slow month, but then we managed to end on a positive note on a monthly basis, and we are still very close to the all-time high. And with the Fed rate cuts, like Gerald mentioned, coming up this month, it could provide another leg, another catalyst to push us towards a year-end rally. So, without wasting much time, I'll let Gerald take over to do the sharing today.
Thanks, Sunny. Okay, the usual disclaimers that today's sharing is for informational purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so in the past week, we saw that the markets were mixed. The S&P 500 closed slightly down by 0.1% to 6,460 points, driven largely by a slight pullback that we saw on Friday. And the Nasdaq also came down by 0.2%. Closer to home, we saw the STI gaining 0.4%, now back to 4,270 points, not too far away from its all-time high. So what we have been discussing and really focusing on is the likelihood of interest rate cut by the US Federal Reserve. What we see here is that the likelihood of a rate cut in September is now close to 90%, and investors seem fairly confident that we'll see a rate cut in the upcoming meeting. So with that, we have seen a sharp decline in Singapore bond yields. The Singapore 10-year government bond yield now at 1.78%, a sharp decline compared to close to 3% at the start of this year. Likewise, for short-term bond yields, we have seen the one-year government bond yield coming down to about 1.55%. Once again, also starting the year at close to 3%. So we have seen a fairly sharp decline in the government bond yields, and that has actually led to questions around which sectors are the key ones that may benefit. So we saw over the past week, some of the top gainers would include the REITs, Fraser Centrepoint Trust up by 3.6%, Mapletree Logistics Trust up by 3.4%, likely driven by improved sentiment towards the REITs, with increasing expectations of the rate cuts. In terms of the top losers, we have got Genting Singapore down by 3.4%, STE down by 2%, and also OCBC down by 1%. So there are two names that I wanted to talk about today, which are CICT and CapitaLand Ascendas REIT. Overall, we see that with the expectations of the rate cuts, the REIT sector has bounced slightly. But even then, we are still down compared to where it was this time last year. So at this point in time, if I were to look at the dividend yields offered by the REIT sector, the office sector offers average dividend yield about 5.1%. Large cap REITs offer an average dividend yield about 5.3%, and some industrial REITs offer a dividend yield of about 7.5%. So that represents a fairly significant difference compared to the 10-year Singapore government bond yield. And that is why maybe some investors are looking more at the REIT sector. So if I were to look at the size of the REITs, the two largest ones that many investors typically look at will be CICT and CapitaLand Ascendas REIT. And those are the two names that I'll go into more detail today. So CICT is one of the REITs that have done relatively well, now at $2.27, having rebounded from its April lows after the Liberation Day tariffs. So as a recap of the exposure for CICT, mixed exposure towards suburban retail, downtown retail, CBD office, as well as other office spaces. 95% of the revenue comes through from Singapore. So if I were to look at the performance of CICT in the first half of the year, they actually managed to grow the distribution per unit by 3.5%. Part of it is driven by the acquisitions that were made in the previous year, which is Iron Orchard, which helped to boost the amount that's available for distribution. Okay, so what we see here, the retail portfolio saw an improvement in the net property income in the first half of the year, and likewise, the integrated development portfolio also saw an improvement in the net property income. Overall, we still see healthy occupancy rates for CICT. It was at 96.3% as of 30th June 2025, quite stable from where it was in the previous quarter. What is also positive for CICT is that the rental reversions still remain positive across its retail portfolio, up by 6.9% for downtown malls and 8.8% for suburban malls, which lead to an overall positive rental reversions of 7.7%. So with that, we have seen an increase in the distribution per unit of CICT to 5.62 cents in the first half of the year, a 3.5% increase from 5.43 cents in the first half of 2024. And that would be a stable increase over the last few years, where we saw that the distribution per unit increased from 10.4 cents in 2021 to 10.88 cents in 2024. What is also an important point to note for CICT is that it has been making acquisitions after the acquisition of Iron Orchard late last year. It recently announced the acquisition of a 55% stake in Capital Spring, which is an office building in the prime CBD area. And it was something that we covered previously in the previous weekly market review. So if you want to go into more detail about this, you can refer to the previous weekly market review. So the acquisition is expected to be accretive to the distribution per unit as well. And the net gearing of CICT is expected to remain below 40% with the equity fundraising that they did with the acquisition. So at this point in time, CICT offers a dividend yield of 4.9%, quite close to the historical average dividend yield of 5.2%. Okay, the next name I wanted to discuss is CapitaLand Ascendas REIT, also one of the largest REITs that are listed in the Singapore market. But compared to CICT, we actually see that the share price is lower than where it was 1 year ago. Okay, so for CICT, so for CapitaLand Ascendas REIT, in terms of the breakdown of its portfolio, 65% in Singapore and the remaining assets in US, UK, Europe, as well as in Australia. In terms of the industrial assets that CapitaLand Ascendas REIT would hold, it is fairly well distributed between business parks, business space and life sciences, in terms of industrial assets as well as logistics assets. Okay, so in terms of the first half performance, we see that the distribution per unit came down slightly to 7.477 cents, which is a 0.6% decline compared to the previous year. So this is in contrast to CICT, where we saw an increase in the DPU, and that likely explained the weaker performance of CapitaLand Ascendas REIT compared to CICT. In terms of the occupancy rate of the total portfolio, it was at 91.8%, a slight improvement of 0.3% compared to the previous quarter. In terms of the rental reversions, that was at 8% in the second quarter of 2025, slowing down slightly from the first quarter of 2025 and the second quarter of 2024, but still fairly healthy reversions across Singapore, the US, as well as in Australia. What we also see for CapitaLand Ascendas REIT is that they recently completed the acquisition of two assets in Singapore. So those acquisitions, including 9 Tai Seng Drive and 5 Science Park Drive, would be expected to increase its presence in Singapore and also expected to be accretive to the distribution per unit. So this is what the company shared at the point of the acquisition, whereby the two assets are likely to be improving its distribution per unit upon the completion of the acquisitions. So what we see for CapitaLand Ascendas REIT now is that the dividend yield is at about 5.7%, which is in line with the historical average and representing a fairly sizable spread compared to the 10-year Singapore government bond yield. Okay, so I've shared about two of the largest REITs in the Singapore market for investors who are looking at the REIT sector. And in terms of what to look out for in the week ahead, we'll be focusing on the non-farm payroll data on Friday, but it's also a short trading week with the US holiday today on the 1st of September. So with that, I'll hand over to Sunny, who will share more about the technical analysis.
Okay, thanks, Gerald, on that coverage on some of the REITs counter that we see on SGX. So let me start my part with the IHS REITs index. So last week, the IHS REIT index up about close to 2%. So that's a very good sign, a gap up and a jump. Of course, that is because we heard from the Fed chair, the US Fed chair, that interest rate cuts are coming. So we are expecting the first cut to come in this month in September. So last year, during this period, you can also see that the IHS REIT index rallied quite a bit. That is also because the expectation of a rate cut was coming, but then that did not materialize towards the end of the year because of the presidential election. And then after that, we saw the tariff war happening, and then this year it pulled back down. So this gap up could be a sign, given that the macro environment, the interest rate cuts might be coming. Interest rates are at the on the lower side now. So this is one, the REIT sector could be one that you could be focusing on to sort of jump on its recovery. So looking at the IHS REIT index now, the level is now at about 1,074 points. The last year high that we saw somewhere in the September period was a high of 1,143 points. So we probably have 10% or slightly less than 10% upside that we're looking at in terms of a technical perspective on where could be the next major resistance level. So that will give you some thought on that. If you want to just get on the REIT sector, you can buy an ETF that track the IHS REIT index. Or if you like to focus on certain sector or industry of the REIT sector, then you could probably reference what Gerald shared earlier, which are the major REITs to look out for. Okay, so on the Singapore side, let's look at the STI index. So you can see my chart is full of key levels to look at. So just based on last week itself, our projection is that the STI index is likely going to stay range bound whenever we sort of challenge the all-time high that we see on 24th July, on 14th August, which now stand at 4,282 points. The index will sort of take some profit off the table. So that is no surprise when last Friday, we see the index sort of get up to a 4,277 points level. This morning, we see some kind of a profit taking on the index, okay, on the STI index, okay. So if you are looking at getting on this broad index, then you will want to look at some of the key support levels. The lower bound of the Bollinger Band has now converged to higher. So the support now, or the low bar of the Bollinger Band, is 4,196 points, or we round it off, 4,200 is the support level that we are looking at for the Straits Times Index. This is followed by the next level at the 50 days moving average, the blue line that you see here at 4,158 points, or we call it the 4,150 points level. That will give another support to the STI index as well. Okay. But if you look at indicators, it may not paint as much of a rosy picture. You can see that MACD has been trending down for the past 2 to 3 weeks already. That means that market is in a consolidation mode. So no surprise, we have been foreseeing that the last couple of weeks. So it's in line with our expectations. So you can see that even though the MACD is coming down, the past 1 week, that downward momentum is also subsiding. So market is in sort of a lot of things are already priced in right now. So market is in equilibrium, I would say. So it will still continue to be range bound, and the level that we set earlier will continue to come into play. Okay. So resistance 4280, support level 4200 with 4150, the 50 days MA providing further support on the lower side. The RSI index is now at 60, a healthy reading, but then trajectory came down slightly today. Okay, so it is also close to the 14 days RSI moving average, so not much of a concern over here. 60 meaning that there could still be some upside potential over here. So a bit of a conflicting sort of a signals from MACD and RSI, meaning that the STI likely is going to stay range bound in line with our thesis. Whenever it touch the all-time high, there will be some profit taking, and once it hit below the 4,200 level, investors will come back in to buy up the index, which consists of the major 3 Singapore banks that we know of. Okay, next let me move to the US index. So another reminder, which Gerald shared earlier, today is the Labor Day holiday, so no trading tonight. But then the US indices also sort of still very close to the all-time high. Last Friday, even though we saw a drop on the US indices, Dow Jones index down by 0.2%, S&P 500 down by 0.6%, Nasdaq down by 1%. This is I wouldn't call it any major concern, because going into Friday, that's the end of the month. Usually traders would close off their position at the end of the month, coinciding with the long weekend that we see in the US side. So some profit taking on the US side is normal, and that could mean an opportunity for us to get back in. Because when I look at the futures, you can see that we have more or less recovered some of the losses on the US index last Friday. Okay, so let me move to the key levels of the US indices. You can see that the Dow Jones index closed at 45,544 points. The high that we saw on 22nd August was at 45,757 points. So that could be the immediate level that we are looking at for the Dow Jones index. So this level is not really the time to get in yet. If you're looking at support level, then we would want to look at least the 20 days moving average. We will always want to get below this pivot so that we got some kind of margin to play with. So 20 days moving average at 44,823 points, slightly below the 45,000, with the 50 days moving average in blue giving more support at 44,424 points. So 45,000 would be my first support level for the Dow Jones index. You can look at the MACD indicator. It has been positive the past 1 week, and that trajectory of the MACD and the signal line looks set to trend higher in the next 1 or 2 weeks or so. Okay, until at least we move nearer towards the interest rate decision by the US Fed. The reading on the RSI at 62 is also pretty healthy. It came down slightly on Friday due to the reasons that I mentioned earlier, but the 14 days moving average of the RSI is at 61, so that could provide support for the RSI to trend slightly higher towards the 70-point overbought level. So Dow Jones index still positive, a bit of profit taking last Friday, but support level 45,000 would be the key support level that we are looking at. Next, let us move to the S&P 500, which clocked a new all-time high last Thursday, I would say. So that level is now at the 6,508 points. We closed at 6,460 points. First support level, as we always say, you can see over here last week, short-term trading, 20 days moving average first support 6,417 points, with a very strong support coming in at the low bound of the Bollinger Band, which is now coinciding with the 50 days moving average at 6,316 or 6,303 points. So 6,300 would be the likely support that we are looking at for S&P 500, so that we can play the range over here towards the all-time high we saw last Friday at 6,460. Indicator wise, I would say it's slightly negative to neutral. The trajectory of the MACD seems to be sort of horizontal, but we still have a slight negative reading. So that means not too much to worry about, but likely index will not sort of have a gap out or break out anytime soon, but sort of be in a range bound formation. That's what the MACD indicator is suggesting. RSI trend down last Friday, but like I said, the reasons we mentioned earlier of profit taking, I think it would likely remain between the 50 and the 50 and the 80 point level. That could mean that there could still be healthy momentum on the S&P 500 index for it to be range bound and sort of start to track the all-time high as well. Okay, next let us move to the tech-heavy Nasdaq Composite Index, which was the only index among the three US major indices that did not sort of touch an all-time high last week. Okay, the highest we went on Thursday was 21,742 points, with the all-time high standing on 13th of August at 21,803 points. So Nasdaq Composite retraced back to the 20 days moving average, now at 21,420 points. So that is the key pivot level that we are looking at with the 20 days SMA, with the 50 days moving average and the low bound of the Bollinger Band finding confluence at 20,900 points. So that is a key level to watch. MACD is slightly trending down. Of course, there was also a sort of a push downwards last Friday, but then not too much to worry because it still largely looks to me as a horizontal kind of movement, meaning that Nasdaq could also be in a range-bound formation. The RSI is at 55-point reading now, below the 60-point neutral mark. So if you have observed the RSI for the Nasdaq somewhere on the 1st of August, it touched the 50 days moving average, the sort of the 50-point neutral mark, and we get a rebound back. It also happened again on the 21st of August. So I would not usually bet against such kind of a pattern forming on the technical indicators. Once it reached the 50-point neutral mark, which is 5 points down, it could be a sign that we should be loading up on Nasdaq Composite Index again, provided it coincides with the key support level of 20,900 points. Okay, so that is my sharing today. Anything else to add, Gerald, for the new month of trading?
Well, I think many investors are really looking out for the Federal Reserve decision this month. Given the rising expectations of the rate cuts, I think that will likely be the key thing that will drive the market this month.
Indeed. So while we trend towards that, don't forget also the non-farm payroll this Friday. That will also have some kind of bearing on the Fed rate decision. So do keep a lookout on that, and we'll update you next week in the next weekly market review. Goodbye.